Welcome back to another edition of the Prepper Recon Podcast. Our mission is to bring you great interviews with preppers from around the world so you can be better informed and better prepared for everything from a hurricane to the end of the world as we know it. I've been purchasing gold and silver from JM Bullion since before they were a show sponsor because they had the lowest overspot price of any dealer I've been able to find. JM Bullion now offers free shipping on all orders, and Prepper Recon Podcast listeners will get $5 off any order over $300. Just go to jmbullion.com and use coupon code PR5 at checkout. Today's guest is John Rubino of DollarCollapse.com. John, welcome back on the show.
Hey, Mark. It's good to talk to you again.
Oh, absolutely. It's good to have you back. So tell us about your new book, The Money Bubble.
Well, it's co-written with Gold Money's James Turk. We did a book previously in 2004 called The Coming Collapse of the Dollar, and this is a book along the same lines but with all new material. And the short version of the premise is that these financial bubbles that we've lived through over the last 30 years, junk bonds, tech stocks, housing, have actually been, kind of mini bubbles that took place on the stage of a much larger bubble, which is in fiat currencies. We call it the money bubble in this book, and it basically it refers to the fact that the national currencies of the main countries have been expanded like crazy without serious consequence so far. But they really form a bubble in the euro and the dollar and the yen and in the concept of fiat currencies. And when this bubble bursts, as it's going to pretty soon because the numbers have just become overwhelming, it's going to change everything. Because, when, say, junk bonds burst, that really affected just the people who were involved in the junk bond market in some way. Same thing with housing and tech stocks. But when fiat currencies burst, that's our money. That's our savings and what we have in our wallets and our pockets. And so it's going to change everything in terms of our economic lives. And so with this book, we walk readers through how we got here, how the next crisis is likely to play out, and how to invest to protect yourself and maybe make a lot of money during the transition.
Well, can you give us a little sneak peek of what you see coming down the pipe?
Sure. Well, one of the interesting things about the past 10 years is that because this whole thing has gone on a lot longer than it really should have. The numbers were pointing towards a catastrophic collapse a decade ago. And yet because the whole world is armed with printing presses now and everybody's able to create as much new fiat currency as they need to prevent a banking collapse, we've been able to build up huge amounts of new debt out there, which will make the crisis even bigger when it happens. And observers have been able to either dust off or formulate a lot of new theories to explain where we are and how we're going to unravel when the time comes. So we devote a whole section of the book to the various scenarios. And we state up front that none of these is guaranteed to be right, but each one should be seen as a lens through which to look at today's world to give you some insight. And cumulatively to give a lot of insight. So one way that things could fall apart is the Austrian economics concept of the crack-up boom, which is a period in which years of inflation have led people to finally realize that depreciating the currency is explicit government policy. And then they just finally give up on the concept of the currency anymore. They don't want to hold it because they know it's going to become less valuable with time. So anytime you get paid, you convert your new money into hard assets right away. You spend it. And that pushes up prices, which looks like inflation, and it pushes down the value of the currency. And so what's really happening is that people are losing faith in the currency. It's not an immediate increase in supply that's causing the price increases. It's a decrease in trust in the currency. And that usually ends up with the currency just not functioning anymore as money and a huge financial crisis like in Weimar Germany. Another way of looking at this is The Currency War, which is the title of Jim Rickards' classic book, which everybody should read if they want to understand what's going on right now. And that's a period of time in which over-indebted countries decide that their only way out of their debt is to diminish the value of their currency. So one country does it and gains a trade advantage because their stuff is now cheaper when it's priced in local currency on global markets. But that disadvantages their trading partners who respond in kind, and you get a race to the bottom in currency values, which also leads to chaos. And one more interesting theory that James and I came up with is the variable rate world collapse. And that is when interest rates are forced artificially low for a really long time. It leads people to either borrow very short, in other words, to just contract in debt for 6 months or a year or whatever, where interest rates are very low, or to take on variable rate debt, which bounces around depending on the general level of interest rates. And that works beautifully while interest rates are going down. But as soon as interest rates start to go back up, everybody's interest costs just explode. And so you've got, especially Japan and the U.S. right now, at the national level, who have borrowed just trillions and trillions of dollars very short term. So we have to roll our debt over continuously, and as interest rates go up, that will blow a hole in our national budgets. And you'd see the U.S. and Japan absolutely implode if interest rates just go back up to normal levels, which for, say, 10-year treasuries would be around 6%. That would be a more than doubling of 10-year treasury interest rates from here. And if that happened, we would be running trillion-dollar-a-year deficits just to cover our interest costs, and not to mention our defense budget and Medicare and Social Security and everything. So we would see our national finances just spin out of control, and that's a very easy thing to imagine. And there's other scenarios in that section, but basically each of these is feasible, and it explains how we could come undone from here. And there are others. So the point being that we've created conditions in which chaos is completely possible. And the only question now is the timing and the specific form of the chaos. So it helps to have a lot of different lenses through which to view the world and to compare what's happening with one theory or another, and then it gives you a sense of which one might end up in the end be the one that plays out specifically.
And then there's no absolute guarantee that we only get hit by one black swan. With all of these black swans flying around, there's always the possibility of two or more. Is that right?
Oh, absolutely. I mean, you could have currency values fall at the same time interest rates spike, and all kinds of other things happen at the same time. And geopolitical turmoil where you've got a major war that, say, in the Middle East that cuts off the oil supply temporarily. All of this stuff is possible. And we've borrowed so much money that the system is extremely fragile. We can't handle too many external shocks, and come out of it okay. And so we're in a position where almost any big thing going wrong would push us over the edge. And there are lots of big things that could go wrong, and very few that can go right from here.
And we've seen that before in history, because the Great Depression, we had the banking system collapse, and at the same time we had the drought and the Dust Bowl going on, which was sort of creating sort of famine-like conditions as well.
Oh yeah, in a healthy society, a financially healthy society, something like the Dust Bowl would be something like Hurricane Katrina here, where we just, it's bad, but we move on. We manage it. And back then it was much more catastrophic. Because we were already in a financial crisis. So yeah, that's, it seems to be a law of life that when it rains, it pours. You don't just have one big problem. You have multiple problems all at once. And a wise person and a wise country, maintains a lot of financial strength in order to deal with the times when you have two or three big problems at once. And an unwise country, unwise society, leverages itself to the hilt in good times and then has no reserve when things turn bad. And that's the kind of society we've designed. We really don't have any leeway now. If one or another form of hard times comes, our only remaining tool is more monetary ease. We're just going to print more money and hope for the best. And what will more than likely happen is that we'll get some kind of instability because of a huge supply of new currency coming onto the market, and that'll make things even worse.
Yeah, that's right. Even on a personal level, it's usually when something goes wrong, you get a flat tire and the dishwasher breaks, and and the dryer doesn't work anymore, all in the same week.
Yes, or you lose your job and you get sick or something like that. It's just, that's how life works. It's just this kind of random thing that sometimes throws a whole bunch of problems at you all at once.
Well, I can't wait to read The Money Bubble. I hope it turns out to be as accurate as your last book, The Collapse of the Dollar and How to Profit from It. In that book, you predicted a real estate bubble, and that was in 2004 that you wrote that book. That was 4 years before the crash, so it kind of gave folks time to get positioned, didn't it?
Yeah, it was a little earlier than I wish it was, because it also gave people time to place some bad bets for a couple of years. But in the end, it played out just about exactly the way we thought it would, because by 2004, there were a lot of signs that we were in yet another bubble. Bubbles have kind of specific characteristics. If you've seen a few, they become very familiar. And among the things that were going on back then was soaring prices, which is the hallmark of a bubble that's visible to most people. And then you in most bubbles, you have regular people making easy money doing things that the experts used to find hard. And in the housing bubble, this was home flipping, for instance. It's hard to buy and sell real estate and make money. And yet you had lawyers and gardeners and school teachers doing it for 3 or 4 years there, and they were already starting to do it in 2003, 2004. And then finally, in a bubble, you usually have tried and true business practices being replaced by quote unquote innovations that are really just cons, designed to keep the deals flowing. And in the housing bubble, we already had liar loans and mortgages with zero down and stuff like that by 2004. And we were starting to see lots of other things like securitization of mortgages into bonds, which were then turned into derivatives. And so it was already becoming absolutely crazy. It had all the hallmarks of a bubble. And, at the same time, gold was incredibly cheap. It had been beaten down for years and years and years and years. So it really looked obvious that housing was going to explode and take the banking system with it, and that gold would be one of the beneficiaries, because terrified money would flow into the one form of money that the governments couldn't print in infinite quantities when they started to panic. So both of those recommendations ended up working out beautifully. People made fortunes by betting against the housing market and the banks, and they also made fortunes by loading up on precious metals. So we see a lot of the same things happening now. Instead of addressing the problems that led to the 2008 crisis, the major governments of the world have basically just done more of the same. They've borrowed more money. They've handed that money to the banks, who in turn have increased their derivatives books and started to blow up asset bubbles around the world. And so we're right back to where we were in 2004, 2005, 2006, with debt soaring and some kind of a crisis imminent.
Well, I would say it's always better to be 4 years early than 1 day late on a call like that. So I'll still have to say it was a good call. And the fundamentals were already in place in 2004. It's just that it's hard to say how long, what's the elasticity of the bubble, and how long it can expand before it finally finds its pin and pops. Now, are the fundamentals already in place for the destruction in the financial system through some of the scenarios that you've talked about in the book? Are they?
Oh, yeah, absolutely. Now, as you said, bubbles can go on longer than reasonable analysts expect, and that's one of the other hallmarks of a bubble, is that you get this last year when most of the people who were calling it a bubble seem to be discredited, because things still seem fine, and then they shut up, and then it blows up. And so this could happen again, where they're able to blow up the fiat currency bubble for a few more years. But as of right now, as of today, the numbers are devastating. There is just so much paper circulating out in the world, and that has no backing other than our faith in the governments issuing that paper, in faith in their ability to continue to manage their currency prudently. And once people figure out that they're absolutely not doing that they're just flooding the global financial system with new currency and hoping for the best, then everything will change on a dime. And so we can't know whether it's going to happen in 2014 or 2017. But the fact that we've issued as much paper currency as we have and taken on as much debt as we have pretty much guarantees some kind of big crisis at some point in the not too distant future. So, personally, I'm getting ready for it now. I'm adjusting my finances to a crisis investing, framework. And buying precious metals and looking into shorting certain parts of the stock market that are dependent on the value of the dollar and the bond market and things like that. So, I'm getting ready, but I'm not all in just yet because, the last few bubbles have gone on longer than seemed reasonable, and maybe this one will too. But if it goes on a lot longer, that just gives you more time to really get your ducks in order. So if you're prudent and steady and don't jump in all at once, a longer than expected bubble is actually a really good thing.
Because it delays the day of reckoning for everybody, for the prudent and the unprudent. But it's just like an unstable bridge. Maybe it's got another 2 or 3 years, but if it's an unstable bridge, you really just don't want to drive across it, do you?
No, I mean, you don't want to be betting on the bubble at this point. Because maybe stocks will go up some more, or especially bank stocks and government bonds and basically financial assets as opposed to real assets. They might have another good year, but they won't have too many more good years. So you don't want to put your life savings in a standard portfolio, which is some cash, some bonds, some stocks, and some aggressive growth stocks. That's what the average financial planner will put a normal client into. And in normal times, like we seem to have been going through basically since World War II, that portfolio works out real well. But when it changes, when you hit a big inflection point in a long-term credit bubble, that's a disastrous portfolio. So you even if the bubble is going to continue for a while, you don't want to bet on it anymore. You want to start pulling back and taking some profits in your growth stock funds and your bond funds and things like that, and converting that money at least to cash for the time being, because that's very liquid, and also to precious metals and oil company stocks and farmland and things that governments can't just create a lot more of when they panic.
And do you see the next period of disruption as being more severe than what we experienced in 2008?
Vastly. 2008 was just a warm-up. It could have been the big one, but we responded to it, or the world's governments responded to it, with $30 trillion of new debt, or 40 trillion, depending on how you calculate debt. If you include unfunded liabilities of pension plans, might have even been more than that. So, they threw a huge amount of new debt at this and stopped the collapse that would have happened otherwise. But the cost was we're now much more deeply indebted and a lot more fragile. So the next one, when it comes, is going to be both bigger and it's going to be fundamentally different because it's going to involve fiat currencies and our relationship to fiat currencies. Once we stop trusting the dollar and the euro and the yen, then, as I said at the beginning, everything changes. The whole world, that has been built up on government's ability to create as much new currency as they want to will change. The U.S. global military empire is basically an artifact of fiat currency. And you can trace it directly back to the printing press because, we have the world's reserve currency. We've got the money that everybody wants. So we can spend as much as we want to on our military empire and then just print the new dollars or create them electronically, send them out into the world, and pay for $1 trillion a year in military and other related kinds of spending, which nobody else in the world can do. So the U.S. global military empire is dependent on global acceptance of the dollar. Let that change, and all of a sudden we don't have an empire anymore. It just evaporates. So that's one big change that we will see at some point in this process of the evaporation of fiat currencies. And the European welfare state is completely dependent on the continuing trust of people in the value of the euro. Let that change, and all of a sudden the unfunded liabilities, in other words, the amount that they have promised to pay for retirees but haven't put away yet, becomes overwhelming. And the European welfare state will collapse. And in Japan, their government owes more as a percent of GDP than any government in history. They have just borrowed so much money compared to the size of the economy. And let faith in the yen be shaken, And their interest rates will have to go up, which means the interest cost will just destroy them. That's the variable rate world death spiral that I mentioned earlier. Japan would be the epicenter of something like that. So, and then they would have to dramatically scale back their social programs, and their retirees who are retiring en masse right now would find that they don't have anything like the benefits that they thought they were going to, and they'll be pushed down into poverty. So, on dollarclaps.com, I've done a series of articles called Welcome to the Third World, about how the developed world is basically running out of money and losing the ability to keep its promises. So in the U.S., you're seeing all these cities go bankrupt. And the first thing they do when they go bankrupt is they cut back on services. They scale back pension plans, and the cops stop coming when you call, and the trash isn't picked up on time, and the libraries close several days a week, and so life just gets harder and harder, and we start to revert to what life used to be like and what it is like in a big part of the world. And that's something that in the U.S. we find shocking, because we've come to accept the fact that everything works here. And the fact that it works is because we've been able to borrow a lot of money to keep it working. So you take that ability away, and all of a sudden things don't work anymore. And that's what we'll see across the developed world when currencies stop functioning the way they have for the last 30 or 40 years.
Yeah, that's a great point, because the deindustrialized third world, which we're going to be, we're just not used to living like that. Whereas the rest of the third world nations, that's all they've ever known. So we're going to have quite the learning curve of trying to figure out how to live like that. Now, another call you made in your 2004 book, and you just mentioned it briefly, was to buy gold. Now, at the time that you made that call, gold was in the neighborhood of about $400 an ounce. And even after the recent pullback, we're looking at about a 200% increase. So that was another good call from that book. What do you expect from gold going forward?
Yeah, well, gold is a form of money that has been around for 3,000 years, and it's been an excellent store of value during that time. And so it's reasonable to expect it to stay that way. Gold will continue to be valuable going forward. So the question becomes, what's it worth in terms of fiat currencies? And you're right that gold has gone up since 2004 pretty dramatically, even after the pullback. But the amount of fiat currency in the world has gone up even more. The total amount of debt and the total global money supply and any other financial indicator of leverage that you want to use has gone up a lot more than the dollar price of gold has gone up. So in the last 10 years, gold has actually become more and more undervalued in terms of the dollar and the euro and the yen. Because you really can't think of gold as having a dollar value apart from the value of the dollar, really. So when gold goes up, it's the dollar going down in value. It's not gold changing in any way. So when the supply of dollars goes up faster than the supply of gold, you would expect gold to go up in dollar terms. And that's what we'll probably see going forward, because the supply of dollars is vastly increased over the last decade. James Turk has done some calculations that equate the amount of gold in the world with the amount of paper currency in the world, and calculate a price that brings the two into equilibrium as a way of figuring out what the intrinsic value of gold is in terms of the currencies out there. And he gets about $10,000 an ounce. And he has 3 or 4 different formulas, all of which cluster around that price. So it wouldn't be at all a surprise to see gold go from here, from $1,200 and change up into the $5,000 or $7,000 range, just in times that feel normal still, when everything is still functioning, but the value of the gold out there is starting to equate to the value of the fiat currency, or to the amount of fiat currency. And then if things get crazy, if we see a banking collapse or a really big increase in government spending and deficits to stave off a deflationary crash and an increase in the money supply, then we could see panic buying of precious metals. And this is also occurring with a big shortage in physical precious metals. While gold has been going down lately, the Asian countries, especially China, have just been buying the heck out of gold. You know, they've been basically vacuuming up all the gold that's been produced by the world's gold mines. And let that continue, and we're going to see shortages of gold in the West and continued demand for gold in the East. And that alone will cause a big spike in the gold price just to bring supply and demand back into balance. So there are lots of reasons to love precious metals right now. And silver, by the way, will be pulled along with gold. So it wouldn't be at all a surprise to see silver above $100 an ounce and gold up into the multiple thousands of dollars an ounce within the next few years.
Yeah, I think that Silver Eagles had a record year last year. They sold about 41 million ounces of silver in U.S. Silver Eagles last year, and that was record demand. And I just don't remember learning about this in macroeconomics that you would see prices fall at the same time you see demand rising.
Yeah, that's one of the really interesting things about this is that in the paper markets where big banks can play games with futures contracts to move the price of things around, that's where the action has been in precious metals in terms of pricing. You know, they've been dumping a lot of futures contracts on the market, which allow them to push the price down. But at the same time, demand has never been more aggressive out there. You know, the Chinese and Indian and Russian demand is causing Western refiners to just empty the shelves. You know, you hear all these stories about how refiners are now getting bars in with dates or serial numbers that register as them having been put in a vault at a central bank 20 or 30 years ago. And so that means that the central banks who are supplying the difference between what gold mines produce and what the Eastern countries want are working their way back through their vaults and getting into the old stuff now. And so the question is, how long can this go on? You know, either the Western central banks will decide that enough is enough and they aren't going to send all their gold to China and then they just stop the process in some way, either by just refusing to supply the market or by allowing the price to go way up. Or you see a default somewhere in some metals exchange like COMEX where they just run out of metal to supply futures contracts who are asking for delivery instead of cash settlement. And that spooks everybody and sends the price through. So, you know, there are lots of ways for imbalances to work themselves out here, but they all point towards a higher gold price as part of the process of working out.
Yeah, I think the COMEX is down to something like 11 tons, and that could be taken out in maybe a month or two's worth of deliveries. Is that correct?
Yeah. The COMEX is kind of a fractional reserve banking system where the exchange holds just a little bit of gold compared to the amount of claims against gold that are circulating in the form of futures contracts. So if you have just a few of those futures contracts demanding payment in gold instead of cash when they settle up, then that would take all the gold away from that's available. And the COMEX would have to either scramble to find more gold or default and just say, okay, look, you can't have gold. We'll give you the dollar value of this gold, but you can't actually have the gold. And when that happens, see, that's like a bank run. And if one bank goes bust and refuses to pay its depositors for their savings accounts and checking accounts, then everybody gets terrified of all the other banks, and they want to pull their money out, and so you get a bank run that spreads throughout the banking system. Well, the same thing could happen in precious metals if a big exchange defaults. All of a sudden, everybody who owns a paper claim to gold or silver is going to want to convert that to physical metal as soon as possible because they're going to be afraid that they're going to be caught up in the next default, and they're not going to actually own the gold and silver that they think they own. And so if that happens, you'll get something called a short squeeze, where everybody who has a claim on gold and silver or is obligated to get some and give it to somebody else, you know, who are short the metal, wants physical at the same time. And the market can't accommodate them, so prices just gap up. And in that kind of a circumstance, you see gold go up $200 in a single day and $500 in a single week. You know, it would be a very abrupt change. And as you said earlier, you can't be late for something like this, because if you're not there, if you're not already committed in the week when this happens, you aren't going to be able to get any. Or if you do get gold, it'll be at a much, much higher price than would have prevailed just a week before that. So you kind of have to line things up early and then be prepared to wait until this stuff starts happening, if you expect it to happen. And put up with the uncertainty and the possible paper losses if gold goes down a little bit in the meantime, in return for the certainty that when the short squeeze comes, you're covered. You've got your precious metals, you've got them in a safe place, and they're yours no matter what.
Now, at the same time you were warning folks of the housing bubble, Ben Bernanke was going on CNBC and giving interviews with Maria Bartiromo, claiming there was no such thing as a housing bubble. Even after the falling prices became evident, he said that he was confident that the crisis would be contained to the subprime arena. Now, are you happy to see Mr. Bernanke leave, or are we jumping out of the frying pan and into the fire with Janet Yellen?
Well, in the money bubble, we compile some quotes from Alan Greenspan and Ben Bernanke to show that they were completely clueless as they blew up these asset bubbles. And if they, these are supposedly the smartest economists in the world, and if they couldn't see something as simple as the housing bubble, then why should we trust these guys or their successors to manage something as complex as a global economy? And, the point isn't that they're especially stupid, though they do seem that way when you listen to these old interviews, but, that modern economies are just far too complex for the human mind to be able to model and manipulate. So all governments can do is create a stable, level playing field with reasonable, very clear regulations, and then let the markets do its thing. So I don't think it really matters who's running the U.S. Fed and the European Central Bank and the Bank of Japan in these circumstances, because they're all drawn from the class of people who believe the opposite of what I just said, that it's possible to understand and manage a modern economy. So they're going to try, and they're going to use the same tools that their successors used, or their predecessors used, because those are really the only tools that they have left. So they're going to create as much new currency as they have to keep interest rates down, and they're going to buy back as many bonds as they need to in order to stabilize the banking system, no matter what the big banks are doing. And that's just going to make things worse. So yeah, Janet Yellen, I don't think is any worse than the guys that came before, but I think she's cut from the same cloth, and I think she's going to make the same mistakes. So it's very possible that she's around when all of this stuff blows up, and that she gets blamed for it. But it's not going to be her fault any more than it's the fault of Ben Bernanke or Alan Greenspan. It's just going to be the class of people who we had in charge during this period that were completely clueless. And so I think historians are going to have an interesting time sorting all this out. But I think the conclusion that they're going to come to is that it was really a mindset. It wasn't incompetent individuals, but it was a mindset of a whole generation of U.S. policymakers that was just completely wrong, and that brought us to the brink of disaster and then pushed us over the edge. So I don't envy Janet Yellen her job, because she's coming into it at a time when there really isn't much leeway left. Things are going to blow up pretty soon, and it could very well be on her watch.
Well, if I were in charge of Fed chair appointments, I'd want to put somebody in there that saw the last crisis coming. So I guess that'd either be Peter Schiff, James Turk, or yourself. So did anyone offer you the job?
Nobody even knows who I am. But I think Ron Paul would be the choice of most people in the sound money community, because he's the one who's been consistently right about where we were headed and why we were headed there. And so he would be a guy who, if they put him in charge of the central bank, he would take it in exactly the direction where it should go. He would either close it down completely, or he would scale back its responsibilities to just standing ready to exchange gold for paper dollars and vice versa at the market's demand. And we'd probably have to wait for market demand to return to sound money in that case. But it would happen. And so that is absolutely not going to happen under the current crop of people. They're never going to name somebody like Ron Paul to a policy position that's that powerful, because he would give up power. And the ability to create unlimited amounts of new money is just such a seductive form of power for a government that none of them ever voluntarily give up that power. So what's going to happen is the market will take it away from them. And it'll happen either through crisis or through people like you educating your listeners and a critical mass of people then demanding a return to sound money. But one way or another, governments will be dragged kicking and screaming from here to there.
Yeah, I absolutely agree. Dr. Paul would be an excellent choice for Fed chairman. I'd love to see him just shut the thing down. That'd be great. Now, does all the trillions of dollars that the Fed's created over the past few years, do they have the possibility of going through a multiplier effect if those dollars start getting lent out? Can you tell us how that might happen in the fractional reserve banking system?
Yeah, the way a fractional reserve banking system works is a bank is required to hold back, let's say, 20% of the deposits that it takes in, which is another way of saying it can lend out 5 times as much money as it takes in. But at that point is when it gets really interesting, because if a bank makes a loan, then the person who receives that loan deposits it in another bank, which can then make 5 times the loans of that deposit. And so on throughout the banking system until you get this huge increase in the amount of money that is created by an amount of base money that the Fed injects into the system. So the Fed has injected trillions of dollars into the banking system over the last few years. And so the question becomes, what will the fractional reserve banking system do with all that base money? You know, they can create trillions and trillions of dollars of new loans out there if they want to. And I think you can make the case for the fact that they've already begun doing this, but that we're not seeing it on Main Street yet. Basically what's happening is the money that's being created in the banking system now is flowing to the 1% who are buying stuff that the 1% likes to buy, you know, yachts and rare art,
Diamonds.
and diamonds and stuff like that. And so we're seeing huge price spikes in those markets. You know, that's where the bubbles are manifesting right now. We're seeing equities also. They own a lot of equities and a lot of bonds. So those financial markets are in raging bubbles right now. And art prices are setting records, and London and Hong Kong and New York City real estate are higher than they've ever been. And so we've got these bubbles going. And the fractional reserve banking system is the vehicle through which the Fed's injection of reserves is being translated into financial bubbles, but we're just not really seeing it yet. So the consumer price index, as the government calculates it, seems pretty well behaved, which makes the financial system look well run. But really, it's just all these asset markets that are outside of the calculation that they do for consumer inflation are in raging bubbles right now. And those bubbles will either spread to the rest of the economy and cause a general rise in prices, or they'll burst and cause extreme instability. And I would probably bet on the latter, you know, just because for the last 30 years, that's what we've seen. We've seen bubbles blow up and then burst, and then the government has to come in and create even more currency in order to deal with their past policy mistakes. And we're liable to see that again, and we're liable to see it on a bigger scale than we've ever seen it before. So I think fractional reserve banking, by the way, we have a chapter in the book that explains all this and concludes that it's the root of many evils. You know, money is not the root of evil. Fractional reserve banking and central banks in today's world are actually the root of most of our financial evils. And, it's possible to set up a system that doesn't involve these things. You know, that you can have a banking system that requires banks to only lend out money that they already have. And we sketch out how that would work in the real world. And I think it's very possible. And the resulting society would be a lot saner, because you wouldn't have these huge booms and huge busts that come from the banks being able to create 5 times as much money as the Fed gives them, and then a bust that causes the banks to pull in all their loans and the money supply contract back to the original base money. You know, we wouldn't have things like that. And that's another hopeful possibility for after the crash, when we sit down and really hash out what kind of society we want to rebuild from the rubble. And one in which fractional reserve banking is a thing of the past would be a really positive development.
Now, does confidence play a role in market stability?
Well, in a fiat currency system, confidence is everything, because the dollar and the euro and the yen don't have any intrinsic value. You know, they're just pieces of paper or bits in computer databases. They're not worth anything intrinsically. So their value depends on our perception of the governments that are managing those currencies doing a good job going forward. And so that's one of the reasons why governments are so aggressive about depressing the price of gold, and why they lie so blatantly about economic statistics and hide so many things, because they can't let us know the truth. Because if we knew the truth, we would see that they're really not doing such a good job of managing their currencies. And as soon as we figure that out, it's over for these guys, because there's nothing forcing us to hold dollars and euros and yen and use them for transactions, you know, other than the fact that legal tender laws require us to pay our taxes in those currencies. But in every other way, we can convert those things to hard assets in a heartbeat if we want to. And they, at all costs, have to prevent us from wanting to do that. So perception management is really the core of modern government economic policy. and it wasn't that way back when money was real. You know, gold and silver were gold and silver. Governments couldn't change our perception of those things, and they couldn't make more. So the nature of money and the value we place on money was beyond the control of governments to a great extent. And that's why things were a lot more stable back then. Even though there were booms and busts, you know, humans will always be emotional creatures that have booms and busts, but they were smaller, and they were over a lot more quickly than the ones that we're building up. So the world was a lot more stable before governments took over the creation of money and became dedicated to perception management. So yeah, to answer your question, perception is everything. And when that perception changes, that's when everything else changes in the financial world.
Do you think that corruption is a risk to the stability of our system? Stephen Cohen of SAC Capital seems to have gotten away with massive insider trading, just like John Corzine, who got away with massive fraud. Does corruption threaten market stability either directly or indirectly through erosion in confidence?
Well, corruption is an inevitable result of the government being able to create more money and give it to the banks, because that makes the banks incredibly powerful, because they get to touch that money first and do things with it before its rising supply diminishes its value. So they become incredibly powerful. They basically take over the government, and then they basically do anything they want to, because the mechanisms and the regulators that used to keep them under control are now their pets. You know, they're just divisions within a big organization that includes the Fed and the commodities regulators and the Treasury Department and the big banks. And so inevitably you're going to get corruption in a situation where these guys can get away with almost literally anything. So the insider traders are that's kid stuff compared to the stuff that Goldman Sachs and JP Morgan Chase and some of the other big banks have been accused of and basically paid fines for over the last few years. And those things just scratch the surface of the stuff that's really going on. So I think that what's happening now is that the regulators know that things have gotten so blatant that they have to be perceived as coming down on the banks and forcing them to change their ways. So they open investigations. They claim that they've found evidence of crimes, and then the big banks settle by paying a fee. But the big banks never see any of their people go to jail or lose their jobs. And so the guys who have been committing the crimes just go on as usual, rich, high prestige, well thought of by everybody in the world. And the banks pay these fees to the government as basically a cost of doing business. And so it's really a farce. And what's interesting is that people are starting to figure out that it's a farce. You know, you ask most people what they think of Wall Street right now, and they're going to tell you stuff that sounds an awful lot like what I just said, that they're basically criminal organizations and that they're getting away with it because the government is in bed with them. And here again, when trust in the big financial systems start to erode, that leads to eroding trust for the currencies that the big financial systems depend upon. And so it's all one piece, and it's all perception, and it's all based on trust. And when that trust evaporates, so does the value of these currencies.
Yeah, if you can steal $1 million and pay a $10,000 fine, then you're doing pretty good.
And that is literally what this comes to, because these guys have, done money laundering or created financial instruments that were basically fraudulent, and they've been doing it for a long, long time. And so they pay a fine this year that is some reasonable chunk of their quarterly earnings. So it looks like a big hit. But if you put it against the money that they made over the past decade doing this stuff, it's a fraction of a percent. It's a rounding error in their P&L. And so to them, it's a minor cost of doing business, and they're very happy to pay it and then go on as business as usual, keep on doing what they're doing.
And it's a little bit like a cockroach. If you see one cockroach, you've probably got 20,000 living in your walls. And we saw the emails from inside Goldman Sachs, and that proved that the traders knew they were selling garbage to customers in the form of subprime CDOs that were AAA rated. And then we also know that the firm made hordes of cash from short position on those same instruments that they were selling and saying that they were AAA.
Oh yeah, the conflicts of interest are just astounding when you start looking into it. They've got guys setting interest rates at the same time that their proprietary trading desks are betting on interest rates, and they've got people owning warehouses that manage the flow of commodities at the same time their traders are betting on those commodities, and it just goes on. And very little of this has come to light so far. So I think that a full accounting will require new people in the government who aren't beholden to the banks and who are willing to actually investigate crimes. And that'll come eventually. It might come after the system starts to spin out of control, and the people in charge lose the ability to keep hiding all of these things. And so it might be a while, but eventually the books will be opened, and historians, if not regulators, will be able to go through it all and come up with a full accounting. And those will be some fascinating books. I'm looking forward to reading, a 2017 book that actually explains what it was that Goldman Sachs and JP Morgan Chase and all the rest of these guys were doing right about now and how they got away with it.
Yes, because I'd certainly think that it would be considered insider trading if you made money on a trade that was based on your own fraud that nobody else knew about except you.
Completely. Oh yeah, that's the definition of insider trading. And with these investment banks and other big banks, it's just business as usual, because these guys, they claim they don't talk to each other. They claim there's this thing called a Chinese wall between different parts of the bank, but obviously they talk to each other. How can you control something like that if there are millions of dollars of profits to be made by going out to lunch together, or having your accountant talk to their accountant, or having the woman that you're dating or the man that you're dating date the other? It just goes on and on. There are all kinds of ways that you can have connections and communication that bypass official channels and let you know what the other guy's doing and profit from it and leave no trace. So clearly it's happening. Hopefully there will be a way to find out about it, if for no other reason, for the entertainment value of reading these stories when the time comes.
Now, what are your thoughts on the IMF working paper by Reinhardt and Rogoff to tax global wealth for a one-time 10% levy? While it may be unlikely, I'm a little hesitant to keep much money in the bank. Is that a rational fear?
Oh, I don't think it's unlikely. I think it's one of the inevitable results of what we're doing today. Basically, the world, especially the financial system, is running out of money, and they're becoming increasingly desperate in their search for new money. And one thing that happened that people should know about is in Cyprus last year, their banks got into trouble, and they didn't feel like they could tap taxpayers to bail out the banks. So instead, they just sucked a bunch of money out of the accounts of account holders and used that money to prop up their banks. And that has now become standard operating procedure around the world. There are plans in place in most of the major countries for during the next banking crisis to do that. they call it a bank bail-in, where the customers of the banks are going to see their deposits looted in order to prop up the banks. And once you open that door, then all financial accounts are basically fair game. So our IRAs and our 401ks and our brokerage accounts will be subject to the same kind of confiscation when governments realize that they desperately need money in the here and now, and they can't go back to taxpayers and ask for any more, because that the resulting increase in deficit spending will hurt the value of the currency, which, perception is everything, remember, they can't allow to happen. So our money is no longer our own. Our savings are basically unsecured loans to the institution in which those savings are deposited. So we need to understand that going forward and take steps to diversify away from, one big account at Citigroup or Charles Schwab or something like that, where the government can just see this account and then go in there and take what they want from it. So I think now is the time to begin a diversification away from financial assets and into real assets that are harder to steal. And that would be precious metals that you store at home or in a vault in a safe place in another country, and land that, although it can be taxed very heavily, can't just be confiscated, or it can't be confiscated as easily. I'm sure that at some point they'll get around to trying something like that, but they aren't thinking of it right now. And other forms of assets that aren't immediately vulnerable to this kind of thing that really is coming. And we probably need to do it pretty soon, because along with wealth taxes and bank bail-ins will come capital controls, in which they limit how much money you can move across borders and insist that you tell them everything about your accounts and possibly demand that you repatriate money. So you need to think this through and recognize that there is nothing that's completely safe anymore. An account in a Swiss bank can be looted almost as easily as an account in a Kentucky bank or something like that. And land can be taxed, and bank, and so it goes on and on. And so what you want to do is not think of making everything safe, but just spread things around in the hope that something is going to survive the confiscation. And because you can't know ahead of time where the confiscations are going to happen or what countries are going to succumb to the temptation, and which companies are going to avoid it and come through this all right, it makes sense to move your money around or spread it around as widely as possible to the extent that you can. And also have assets that are just unreported, stuff that you keep at home that isn't on any bank account statement and isn't directly reported on your taxes as your fallback position, the stuff that the government doesn't necessarily know about, and the thing that you're going to get to keep even when all the rest of this stuff is being threatened.
Well, John, that's a lot of great advice and a lot of good information and stuff to be thinking about. And, of course, we'll have links to your website and a link to purchase The Money Bubble through Amazon in today's show notes. But for the folks listening on iTunes, YouTube, and Stitcher, can you tell them where they can find you?
Sure. I run dollarcollapse.com, which is a continuously updated website that covers most of what we talked about today. And you can find links to The Money Bubble there, which will take you to Amazon and other places where you can buy it.
John, thanks again for coming on the show.
Great, Mark. Thanks. Enjoyed it.
Hey, Preppers and Patriots. My new book, American Exit Strategy, Book 1 of the Economic Collapse Chronicles, is now available in audiobook format through Amazon, iTunes, and Audible. Of course, you can still purchase the Kindle edition or paperback edition through Amazon as well. God-fearing patriots and those who believe in the Constitution will find this near-future dystopian novel to be right up their alley. Those who are looking to be more informed about the potential threat to America's financial stability will learn what to watch for and how to prepare themselves for an economic collapse. In Book 1, America is on the cusp of financial annihilation. Matt and Karen Baer face the challenges of Main Street during a full-scale financial meltdown. Government borrowing and monetary creation have reached their limits. When funds are no longer available for government programs, widespread civil unrest erupts across the country. Matt and Karen are forced to move to a more remote location, and their level of preparedness is revealed as being much less adequate than they believed prior to the crisis. American Exit Strategy uses survival fiction to take an in-depth look at the real-life politics and economics behind the issues that are likely to trigger a currency collapse or financial meltdown in the near future. American Exit Strategy is a work of fiction until it becomes history. God bless and happy prepping. This episode is brought to you by CampingSurvival.com. Whether your plan is to bug out or bug in, CampingSurvival.com has all of your preparedness needs, including bug-out bags, long-term storage food, water filters, gas masks, and first aid kits. Check them out online today at CampingSurvival.com. Be sure to enter coupon code Prepper Recon for a 5% discount on your